Imagine this. You're at the Hyatt Regency Chicago, immersed in insightful discussions with the healthcare industry's top leaders. Welcome to Becker's 12th Annual CEO and CFO Roundtable from November 11th to 14th, 2024. Picture yourself networking with over 1,000 executive-level attendees, collecting business cards and forging valuable connections. Feel the excitement as you engage in 4 days of sessions featuring 400 elite health system speakers. Envision yourself diving deep into critical topics like rural healthcare, digital transformation, health equity, and C-suite diversity. Now, imagine being inspired by our celebrity keynotes. Pro Football Hall of Famers Troy Aikman and Emmitt Smith, 43rd President George W. Bush, and author and journalist Jenna Bush Hager. Their stories will leave you motivated and energized. Don't miss this unparalleled opportunity. Get registered today. Visit beckershospitalreview.com and click on the events page to find the conference website. That's the beckershospitalreview.com events page. See you in Chicago.
This is Scott Becker with the Becker Private Equity and Business Podcast. We're visiting today with John Lowell of October 3 Consulting. And John's going to tell us what they do, what they're seeing with sort of pension plans and other sort of benefit plans and a lot more. John, can you take a moment and tell us about you and what you all do?
Sure, Scott. Thanks. And thank you very much for having me. So as Scott said, my name is John Lowell. I am a partner and actuary with October 3 Consulting. I've been in this field for almost 40 years with a specialty during almost that entire career in what I would describe as corporate pension plans. So in the broader way of thinking of that, think of corporate in this context as everything but governmental. So this would be large corporations, smaller businesses, and tax-exempt organizations that are also running businesses of that sort.
Thank you. And tell us, what are you seeing in the market now? What's going on in the pension market now, the benefits market? What are you seeing?
One of the big things we're seeing, Scott, is that there's a lot of problems right now, and while this is not going to seem like it's necessarily related to pensions, it really is. There are a lot of problems with recruiting and retaining employees and with workforce management. So way back when if you think back to the 70s or 80s or even in the 90s, there were a lot of pension plans out there, and gradually over time, for a number of reasons, many companies stopped offering them, and they went for retirement benefits, to what we might think of as a 401k only model, or if you're in the tax-exempt world, a 403b only model. So what that means is employees are saving money when they're able, and if they're able to save, in many cases, they get a matching contribution from their employer. On the other hand, though, if they are not able to save, they are stuck with no increases in their retirement benefits for that year. And in fact, when you think about the way retirement income works, it's a little bit complicated, but what they're really stuck with is a decrease in their long-term retirement income if they're not able to save in a particular year. So all of this kind of ties together because when people, and this is really happening in the 2020s, when American workers are very stressed about their ability to someday retire, this cuts down on what we think of these days as financial wellness. And when your financial wellness is suffering, so too are both your physical and mental health. So there's a little bit of a death spiral there. And a lot of what we're trying to do is to work with companies to help them find ways that are both affordable for the company and sustainable for the company, to give their employees ways to feel better about their finances long term through their working lifetime and into and through retirement. What we're finding when they're able to do that is those employees no longer spend good portions of their workday wondering how they're going to pay their bills, how they're going to get out of debt, how they might someday retire, and they're actually focused on their jobs, which in turn makes the company more profitable.
Thank you. And what do you see in the long run? If you went back a generation, my father still has one. He had a pension. Where are pensions still today? Are there still pensions today versus defined contribution plans? What's the landscape out there in terms of pensions?
It's a great question, Scott. And I think we see pensions in 3 or 4 industries predominantly right now. We see them for different reasons. Some of these pensions are ongoing. Some of them may be frozen where only a small population of the workforce still has them. But where we're seeing them right now, I would say we see them in financial services industries. If you think about banks do tend to have money, and using some of that money to invest it in their employees for the longer term is actually, when you think about it, it's a good way of diversifying assets. The energy industry has traditionally had pensions, and it continues to. Again, the energy industry as a whole has always provided particularly good employee benefits. That's kind of been the benchmark within the energy industry, is to provide very, very good employee benefits. And it's almost needed in order to compete with with your benchmark competitors within that industry. Old line manufacturing still has a fair number of residual pensions that might have been around since times as early as the 1940s or 50s. So coming out of World War II, and the need for people to have pensions to be able to prepare for retirement, and they're still around. And then the fourth area, which to a lot of people is the most surprising one, is hospitals. And hospitals in particular are a little bit different than all of those because they tend to run on very tight margins. But at the same time, turnover, attracting and retaining skilled workers, and more than anything these days, nurses who are suffering from tremendous burnout, if you can keep that feeling of burnout down by taking one stress off their plate, and that particular stress coming off their plate might be thinking they have the ability to save for retirement someday, that does a tremendous job of keeping nurses around. I know with organizations that I work with, they've compared themselves to competitors that do not have pensions, and they've found that their turnover, particularly in their nursing staff, is far lower than the organizations that they are recruiting against. Saw a really frightening piece of data a couple of weeks ago in an article that I found online, and it said, and it's just a short sentence, I'll quote it. Notably, registered nurses are especially concerned, with only 14% of them stating they feel very confident that they will have an adequate retirement income. So when you think about that, if the other 86% don't really think they'll be able to retire, that's an additional stress they don't need. If all they have is a 401k, or as is oftentimes the case in a hospital, a 403b, if you're not familiar, it's roughly an analogous plan, but for the tax-exempt world. If the only way they can access the money that they need is to withdraw money, and it might be the only way they can withdraw is to leave the organization, well, that generates unwanted turnover. And unwanted turnover in nursing staff in particular tends to cost about 55% of pay, so 55% of 1 year's pay for hospital organizations that are run particularly efficiently. And in some parts of the country where hiring is much more difficult, the number might be twice that much. So it might even exceed 100% of pay. So if you can find ways to spend money in order to save money and run more efficiently, that might ultimately be to your benefit as an organization.
No, you're really fascinating. And talk a little bit about, are a lot of systems trying to improve their pension benefit plans for employment? Are people willing to do this, or they're so scared of the cost that they're afraid to do it? What do you see out there in terms of hospitals, health systems, or other large companies that still rely on pensions?
It's a great question, Scott. And a lot of these organizations, you make a very good point. A lot of these organizations, the CFOs and the direct reports to the CFOs really are scared of pensions. They saw what happened with them in the late 80s and in the 90s and in the early 2000s in particular. And what really scared them, or continues to scare them, was not necessarily the long-term cost, but it's the volatility in cost. If providing a pension costs you $1 million 1 year and $10 million the year after that, nothing the year after that, and then $5 million in year 4, that's really difficult to budget for as a finance executive. So what's the easy way out? You go to a 401k model, and in the 401k only model, even if you miss budget, you tend to miss it by a little bit. But we have seen a lot of innovation in the pension world, and there are designs that we are coming up with now that have been facilitated by some of the law changes over the last 15 to 20 years that actually allow employers to provide pension benefits that are very similar to what they provided back in the 70s, back in the 80s, in the 90s. But what makes them different is the way they're structured does 2 things. It keeps the costs very, very manageable. So if you set a budget, we can design a plan that's going to keep you exceedingly close to that budget year after year. And these are plans that employees can really understand. They're account balance plans. And so what that does is it provides a much more happier and a much more aware employee experience. As an employee, if you see that you're getting a great benefit and you really understand it, that might be something you don't want to leave and go somewhere else where they don't have that benefit. So when you see this benefit and you see it growing year after year, and it's growing without you having to manage your own finances in order to make it grow, that's a really good feeling. So the plans we're looking at today, they fall into a category typically that has been around for just about 40 years now. They're referred to as cash balance plans, and they are essentially, they're pension plans that will look like 401k plans. As an employee, you have an account balance, and that account balance grows with an amount that's contributed to it every year, plus some interest on it. The newest versions of those actually allow for that interest to be tied to an actual pool of investments. And from an employer standpoint, the really neat thing about that is that the plan assets and the plan liabilities move together in sync. And that's why we're able to keep these plans on budget just as well as any 401k or 403b plan stays on budget. So people see this and they say, well, yeah, but I can get lifetime income from a 401k plan or a 403b plan. But the stark reality is that very few people do. Another part of that reality is even if you can, that lifetime income costs you as the employee about 10% more than it does from a pension plan. So in other words, if you have an account balance that will generate $1,000 a month from a pension plan, that same account balance will probably only generate $900 a month in retirement from a 401k plan. So there's this whole matter of efficiency. And these new plans that we're seeing now that actually work pretty well to solve all these problems, they're called market return cash balance plans. That's the most common name you see. Sometimes they're referred to as market-based cash balance plans. But what's kind of cool about them as well is an organization can have one of these plans. So they can put in one of these plans, and then at the same time, they can give their employees an opportunity to save in a 401k or 403b plan as much as they would like to. So they can have benefits in both of these plans where one of them is specifically geared to providing lifetime income to work with your Social Security benefit, and the other one is geared to providing supplemental savings. So it kind of supplements that pension either for discretionary spending in retirement or for necessary spending in retirement if your pension isn't big enough.
Fascinating. And you referred to the fact that underfunded pensions periodically would provide a lot of volatility to sponsors of the pensions who had to sort of make good those underfunding. The people of my generation remember that. People having big pension benefit shortfalls and having to deal with underfunded pensions. I don't know that anybody under 30 or 35 would know very much what you're talking about. I, of course, am much older than that, so I remember. Tell us a little bit about the underfunding of pensions and what used to happen in the mark-to-markets and stuff like that, if you don't mind spending a moment there.
That's a great question, Scott, as well. And that also ties back to what I was just talking about. So ever since about 1987, the costs of pension plans have been largely tied to market interest rates. When interest rates fall, the costs increase. When interest rates rise, the costs decrease. Well, going back to the late 80s and going until the last 3 years or so, we've had a trend towards almost perpetually stable or decreasing interest rates. So that meant that over time, every time a pension plan sponsor thought their plan was well funded, give it another year or two, and it wasn't necessarily so well funded unless their assets in the plan were performing particularly well. So when these plans were underfunded, that was one more reason that employers tended to get out of them. If a plan's underfunded as a plan sponsor, as an employer, what do you have to do? Well, you have to make up for that underfunding. Just like as an individual, if you find yourself in debt, you don't just have to pay for your current expenses, but you also have to pay for your sins, so to speak, of the past. You can think of your credit card debt as a measure of personal underfunding, and you notice that your credit card company makes you make a bigger payment when you have debt than when you don't have debt. So similarly, an employer with an underfunded plan has to make a larger contribution. They have to take a larger charge against their P&L for accounting purposes, and it gives them one more reason to say, I don't want this. But with these new designs, as I explained in a little bit of detail a couple of minutes ago, when I design these plans properly with these market returns being given to plan participants, what I have is I have my assets of the plan and my liabilities of the plan move together. So when one increases precipitously, the other one increases precipitously. When one decreases, the other one decreases. And that's how I'm able to keep my costs stable. And so as a consulting actuary, that's how I'm able to go to chief financial officers and say, you give me a budget and I can get you as close to that budget as you want on this plan as I ever could in the 401k world.
Fascinating. John, where can people learn more about what you and October 3 does? Where can they reach you?
Well, our website is october3.com, and 3 is actually spelled out, THREE. Or someone can reach me at my email at JLOWELL@october3.com.
John Lowell, October 3, thank you again for joining us today. It's always a pleasure to visit with you and your team. What a brilliant team. Thank you for joining us on the Becker Private Equity and Business Podcast.
Thanks so much, Scott. Appreciate it.